Good afternoon, friends. Uh, Thank you for coming here this afternoon. Looking forward to a great session with all of you. Today we're going to talk about a new NFO at Motilal Oswal Asset Management. But before that, I will just maybe take a couple of minutes to really give a brief introduction. So my name is Pratik Oswal, and I head all our passive funds, ETFs and index funds at Motilal Oswal Asset Management. So we've been now one of the fastest growing asset managers in the country, and we have across maybe around 35 plus index funds and ETFs across all categories. So I'm happy to answer any questions related to our passive business at our asset management company. But for today, we're talking about a very interesting fund. This is the Motilal Oswal Nifty 500 Momentum 50 Index Fund. So we'll probably take about maybe 30 minutes to talk about the fund and its features, and then we'll maybe we'll have a Q&A session. For all our viewers, please feel free to ask questions in the comment box. And once I'm done with the presentation, I'll obviously get back to you with any answers. So with that, we'll start with the presentation. So today we're going to talk about a very special fund. It's a fund where we have worked very hard to launch. It's fund that we've designed in-house at Motilal Oswal Asset Management, and we've worked with Nifty. So this is a passively managed fund. This is an index fund. And the idea behind this fund is that we will be replicating the returns of the Nifty 500 Momentum 50 Index. So we'll talk about what passive investing is. We'll talk about what factor investing is, and then we'll obviously talk about the fund as well. To start off with, just to reiterate, this is a passively managed fund. So there is no fund manager who makes a call about which stock to buy, which stock to sell. We're just basically replicating the index. So the index has 50 companies. We will be essentially having the same 50 companies in your portfolio. And if the index does 25% this year, we would also aim to do the amount the same. So that's essentially what we're trying to do. But basically, let's talk about factor investing, and let's talk about momentum as a factor. So today, within index funds and ETFs, we all have heard of Nifty and Sensex. Those are very popular. But there are index funds across many categories. You have international index funds like S&P 500, NASDAQ. You have gold and silver. You have mid cap, small cap, multi cap. But you also have this category called factor funds or smart beta funds. And the whole idea behind factor funds is that it has the benefits of both being an active as well as of a passive fund. When you're investing in a smart beta or a factor fund, you're essentially getting a fund which has the low cost nature of a passive fund, but also you have the advantages of the high returns that come with actively managed funds. So it's actually the best of both worlds. What we've seen in India and also globally, that factor funds over long-term periods tend to outperform your broad benchmarks like your Nifty and Sensex. And even in India, there are 4 popular factor funds today. You have momentum, low vol, value, and quality. All 4 factor funds have outperformed the broad benchmarks like Nifty 50 over the last 10 to 15 years time. However, momentum as a factor actually has done the best in terms of performance. So for today's presentation, we'll only be talking about momentum factor. But essentially, what factor investing is that it's basically taking, so if you look at investment today, we are essentially, I think, if you're looking investing today, you're essentially investing in strategies. So a lot of fund managers would have a quality style, they'll have a value style, they have, a growth style of investing. So the idea behind factor investing is to actually have these sort of styles in your portfolio, in an index format. So essentially, when you're buying a momentum base of index, you're essentially buying an index that buys stocks that are performing really well in the past. So the whole point for factor investing is that it aims to replicate active style investing in a very low cost and a systematic way. So that's what factor investing is. Momentum factor is very interesting. So what is momentum factor? Momentum factor is a factor where you are essentially buying stocks where the price increases are very large. So out of the universe of Nifty 500, which is the top 500 stocks in India, you're looking at buying 50 stocks that have the highest price momentum. So 50 stocks that have run up the most in the last 6 to 12 months time. And essentially, when the trend solidifies is when, or when the trend falls is when you sell your funds. So essentially, you're buying 50 stocks and you're rebalancing this portfolio twice a year in June and December. So that's the momentum factor. What we use is just price and nothing else. There's a saying, Bhav Bhagwan Che. What that means is that price is the most important thing. And when it comes to momentum fund, price itself is the most important aspect that we use to select the stocks that we buy into. So very important, very simple. And what we've seen is in India and also in the world, momentum is one of the largest factor funds in the world. In fact, what we've seen globally is that factor investing is the second biggest category in the world after broad-based funds. So after your S&P and Nasdaqs in the US, factor investing is the second biggest category. So, we believe that it can also, in India also, as you can see, just 3 years back, Motilal Oswal was the first ones to launch factor funds back in 2021. And back then, this category was just under 1,000 crores. Today, you're looking at this category that's risen to about 35,000 crores. So 35x in the last 3 years, and we can expect this to easily go up another 4 or 5 times in the next 1 or 2 years time. So a lot of interest coming in factor investing, factor funds, and momentum is the one fund that has gotten the most traction. So that's factor investing and factor funds. Let's talk about the fund that we are launching now. So the NFO of this fund has already started. It was the 4th of September, and this will end and on the 18th of September. So please, I think watch out for the last date. And basically, what this index means is you're taking a universe of Nifty 500. So Nifty 500 means the top 500 companies in India. So that includes large caps, mid caps, and small caps. And within that, you would buy 50 stocks that have the highest price momentum. The stocks which have risen the most in the last 6 to 12 months time is what you would purchase in this index. And you'll also, the index is structured in such a way that the large companies will give a slightly higher weightages. So, it's a good mix of large cap, mid caps, and small caps. And as we've seen, momentum in the market changes a lot. So this index gets rebalanced every 6 months, and you see that the stocks change quite often in this index. So it's a very dynamic index. You'll see that the new sort of cohort of stocks come in every year in this index. So I think it's the dynamic index, and we've seen that the performance of this index is also quite impressive. In fact, we've studied this index versus every single mutual fund in the country in the last 10 to 15 years time. And what we've seen is that this index has actually beaten all mutual funds over a 10-year period. So it's a really it's probably the most effective investing strategy, at least historically, so that's very important. What we've seen is that the index started in 2005. And since then, the index has risen by 25% CAGR versus just 15% for the Nifty. So good amount of outperformance. Most people understand 10% outperformance, but how does it relate to compounding? And what we've seen is that if you'd invested 1 lakh into Nifty, it would have been about 15 lakh, which is still very good. But if you invested 1 lakh in this index in 2005, it would have been about 76.5 lakhs. So very, very stark differences. Just 5 to 6 or 10% is a big number, but you can see that how it relates to the sort of appreciation that you can expect in this particular investing style. What we've also seen is that this index is, also done well across periods. So last year was also again very good, but if you look at it from a 3-year or a 5-year or a 7-year or 10-year, it has delivered approximately 10 to 15% outperformance over a Nifty 50. So very good outperformance. We've seen in this index over the long term, and very important. I think the momentum as a strategy. Why does momentum work very well? Why does something like price, which is so simple, works very well? What we've seen in the markets are very adaptive. So, price is the best way to track where the markets are headed, or there are any changes in the market. For example, this index. So we've seen that a lot of mutual fund, fund managers have different styles. Some are quality based, some are value based, some are growth based. And what we've seen is that the markets are dynamic. So, some styles work in a certain time period, and some styles don't work in a period. For example, quality investing hasn't really worked in the last 5 to 7 years time. Growth investing has worked very well. Value investing has worked very well in the last 3 years. It's been the highest performing strategy. But what momentum is doing is that it's basically tagging along, or you're piggybacking on the best strategy that's working at a point in time. So for example, momentum in 2015 would have been quality, because quality was working. Momentum would have been, say, growth in the last 4 5 years. Momentum would have been value. So whenever value is working, momentum will become value. Whenever quality is working, momentum will become quality. Whenever growth is working, momentum will be growth. So it's a very style agnostic strategy. It will sort of really shift in terms of dynamics every time there's a shift in the market. And I think that's one of the USPs of this fund. It's very style agnostic. It will do whatever is working. So it's that's something which is very unique. The second thing which is very unique is that not only style, but it's also a very sector agnostic fund. This slide is very interesting. It talks about how this fund has the sector allocation in this fund every year is so different from each other. So different from each other, which shows that there's a lot of dynamic rotation happening. And this so every color is a different sector, and as you can see, there's no difference between last year and this year, or and this is actually every 6 months. So if you look at yearly sectors, you'll see something which is completely different. So and the reason why this is important is because what we've seen is in India, cycles tend to be very, very small. So, for example, in 2020, if you remember during the COVID crash, healthcare stocks did really well. And this index had a 40% exposure to healthcare. If you remember the year after, oil and gas commodities did really well. This sector had a very high exposure to oil and gas. Even when it comes to I think financial services, this sector has done this index at a very high exposure in 2022 when financials were doing well. So it's one of the best sector rotation funds out there. So again, style agnostic, sector agnostic, and very important is also cap agnostic. This is a fund which is essentially this is a large, mid, and small cap fund. So whenever small caps do well, small cap exposure goes up. Whenever large caps do well, large cap exposure goes up. As you can see, last year, small caps, as you remember, did really well. It had a 35% exposure to this index. To this year, it's down to about 5% because large caps have rallied. So again, very, very dynamic fund. It's a flexi cap, multi cap sort of a scheme, which is which is something which we believe is excellent in terms of so it's also very cap agnostic. So very, very easy to understand. In terms of performance, it's very important. So I didn't mention before, but when you look at factor investing, we talked about the fact that factor investing outperforms in over the long run. But very importantly, just like any other style, factor investing also underperforms in certain market conditions. So as an investor, you have to, when you're investing in a factor based fund, you cannot expect it to outperform at all time periods. There will be time periods when factors do underperform. In this sort of a fund, which is the momentum fund, factors do extremely well in terms of in the performance in bull markets. As you can see in bull markets, and I'll show you calendar year data, there is very heavy outperformance. Bear markets, there is some underperformance, and recovery market, which is in between bear and bull markets, we're seeing outperformance as well. So again, it's a strategy that does extremely well in bull markets. But what's important is that the scale of outperformance, or the scale of outperformance in the bull markets, is very, very large. For example, 2007, if you remember, we had a huge bull market. There was a 60% outperformance. 2000, again, 2012, we had a 20% outperformance. 2014, we had a 40% outperformance. Again, 17, we had a 40% outperformance, and 21. So every time the markets are up about 20 to 30%, this index would outperform that by 30-40%. So the scale of outperformance in a bull market is very high, which is something which is why we don't really suggest timing this fund. Don't say that I expect a bull market to not happen next year, so I will not buy this fund, because if there is a bull market, then you're losing out on very high returns. So again, the does well in bull markets, but the scale of outperformance is extremely strong in a bull market. And as you can see, this is just a return profile of this fund. Again, I think historical returns are quite amazing, and we would, honestly, I think in terms of expectations, you can expect, at least from where we are right now, to maybe not have the same amount of outperformance that we've seen in the past. So I think investors should expect some outperformance over, say, a Nifty 50, but maybe 10 to 12% might be over the long term. Might be a little bit high. So, but still, just to innovate, the index has done extremely well, and we expect this outperformance to continue in the future as well. So again, good amount of outperformance. I think good strategy, and even your SIP returns. A lot of investors tend to invest through SIPs, and even SIP, if you can see, it's close to 11 to 12% outperformance over broad-based indices over a 10-year period. So I think very healthy performance. Obviously, long term is something which we really think this particular fund can be very strategic to your core allocation in terms of the fund. So that's about the fund. That's about the factor investing. We have at Motilal Oswal, we have another momentum fund that we launched 3 years ago, which is the Nifty 200 Momentum 30. And the most common question we get is, how is this fund different from the Nifty 200? So this is just a primer. That fund is something we launched 3 years back. It's done phenomenally well. I think it's created a lot of wealth. It's outperformed in a very big way. But we believe that the Nifty 500 Momentum 50 is a slightly better fund. It's a slightly more flexi cap type of a portfolio. You have more number of stocks. You have 50 stocks, so it's more stock diversified, sector diversified, and it's also done better in terms of returns, close to 5% outperformance. So I think we believe that both are excellent products, have very similar methodologies. One is primarily a large cap fund. The Nifty 200 is mostly a large cap fund, whereas the Nifty 500 Momentum 50 is a flexi cap type of fund. So those are the broader differences. We as a house are slightly more bullish on Nifty 500 because it's a much broader universe, and we believe that over the long run, Nifty 500 is going to be this index that will emerge the strongest. So this is a pure differences between these two indexes, for people to understand. And what we've seen is that, again, returns should not be the only component, but we've seen that this fund has outperformed the Nifty 200 index over the last 10 to 15 years time. So again, returns also on the positive side. In terms of why you should invest in this fund, again, as I said, momentum as a strategy is done extremely well. It's one of the highest performing, best. Best is the wrong word, but it's one of the most effective strategies that we've come across. We launched 35 funds, and this is not a sector, not a thematic fund. This is a very multi-cap, flexi-cap type of a portfolio. So, we believe that this could be applicable to most investors who have a multi-cap, flexi-cap fund in their portfolio. So again, it offers momentum, and momentum is something which not many AMCs have. It's a very unique strategy. It's style agnostic, so it will catch on to whatever is working. It's rules based, so it's passive, so it's low cost. And also, I think what you've seen is that it has the potential to outperform broader markets, especially during upward trending markets. We believe that the next 2 or 3 years are touted to be excellent for Indian markets. So, if you are to believe that we are continued on this bull market, then this is something which would obviously do very well for investors. So, with that, I think I'll just quickly wrap up, and then maybe we can open it up for a Q&A. But I think reiterate. So this is the NFO of the Motilal Oswal Nifty 500 Momentum 50 Index Fund. This is a passive fund, index fund, which replicates the Nifty 500 Momentum 50 Index. It's an index which is a momentum style index fund. So basically, the methodology is buying stocks that are in momentum. So you're buying trending stocks, and philosophically, buying trending stocks over short-term periods has done extremely well in terms of performance. This fund has outperformed the Nifty 50 over multiple periods by 10 to 15%. So performance has been quite stellar. And we believe that it's a sort of a strategy which is also missing in most portfolios. People tend to have quality-oriented strategies or value-based strategies, but not many investors have momentum-based strategies. So it adds a very different flavor to your current portfolio. and also you can expect at least the expectation is that this strategy will continue to do well in the future also. What's also very important is that factor investing in India is going to be a big thing in the next 10 years. If US close to $4 trillion is invested in factor funds, and in India also we're seeing similar growth rates of factor investing. So this is a good opportunity for a lot of investors to come into strategies that are effective early. I think we're still in a very, very early stages of factor funds. It's still a very small category. And we believe that this category will only go up. So I think this is a good opportunity for anyone looking at adding something new or adding something innovative or adding something which is effective in their portfolio. So we believe that this is a strategy which will obviously do very well, and you're having an opportunity of getting in early. And just to end with the NFO of this fund starts on the 4th. It's already started. It will end next week on the 18th, and we look forward to good participation for all the investors. Please do reach out to me on social media, on Twitter, LinkedIn. I tend to get back to most people who message me. But with that, we'll open the floor for questions. If anyone has any questions on the fund or anything, please do put it on the chat box, and I'll obviously get to it. So thank you. Start Q&A. Yeah. So I'll just take a few questions. So Subhash Chandra asked that he added 20,000 lump sum 2 days back. He wants to add more. What can I do? Do I have to wait for any? No, you can actually do multiple transactions in the NFO. So you can just add a fresh transaction to this NFO, and you will get all the units credit to you at the NAV of 10. So you can do multiple transactions. That's perfectly fine. I hope that answers that question. Mohammad Faizan asks, what is the return distribution of the fund across 3, 4, and since inception? Since inception, which is April 2005, and this is not the fund; it's the index. The fund this is the first fund of its kind in India. So the index return, and I had the slide somewhere here only. The index is delivered about since inception about 25.2%, but this is the return stream that you can see over a 3, 5, 10-year period. I hope this answers your question. Amit Kumar Srivastava asks, who is managing the fund and how much experience they have, because experience would be a factor in momentum fund. So Amit, this is a passively managed fund. We don't essentially, these are Nifty based indices, and Nifty is the main, I would say, entity that creates the fund and gives us the allocation. And our job is just to replicate this fund, into a mutual fund. So if Nifty tomorrow comes up with a rebalance and tells us that, as of July, you have to have these stocks in this proportion, all we do is just replicate it, nothing else. So our job is to actually make sure that the tracking error of the fund and the index is as low as possible. And there's good news for you, Amit. As an AMC, we have some of the lowest tracking errors in the industry. So, one of the things which me and personally my team is very proud of is efficiency is one of the highest priorities for us. So the differences between the index and the fund is very, very, very small. I have a slide that talks about the tracking error. Yeah, this is the tracking error of a lot of our funds that we manage. These are funds that are very popular. A lot of investors come in, and as you can see, there's a tracking error for a Nifty 500, which is a 500 stock index, is 0.14. A Nifty 50 index tracking error is 0.04. So as you can see, I think we do a very good job of managing product, and I think that's what's important, when it comes to managing an index fund. I hope that answers the question. Then someone asked that the dynamics and narratives changes every month or so in the market, but the stocks are rotated every 6 months and will not miss out on huge opportunities. So it's a good question. We rebalance the portfolio about 2 times a year. And the question is that enough? And the answer to that is that we've done a lot of research whether you should rebalance the portfolio once in 2 months or 3 months or 6 months or 1 year. And sorry, truth be told, it doesn't matter as much. Yes, I do agree with you that 6 months might be a very long number, but what's going to happen is if you rebalance it every 3 months, you'll just introduce churn in the portfolio. If you look at this index, one thing that people don't realize is that this is a very high churn index. So you're essentially the entire index changes every year. So you're looking at about 40 to 50% changes in the index in the fund every 6 months, because that's how, as you said, sectors are rotating very quickly, stocks are rotating very quickly. So to be able to be dynamic in the fund, you have to rotate quickly. So I do agree with you that we might miss out on opportunities. But what's important, say that you're buying a 50 stock index, so and none of the stocks are really high in weightage. So what you're depending on is not one or two stocks that do well. You're essentially depending on a portfolio of stocks doing well at the same time. And which is why the portfolio, you have to give the portfolio about 4 to 6 months minimum for them to exhibit that one way upwards sort of performance or outperformance. Which is why we believe that 6 months is very good, because it balances out. It takes out the stocks that are not in momentum, but also it gives enough time for the stocks to perform well over 6 months. And thirdly, what we believe is that if you do it monthly or quarterly, then you're adding a lot of costs, transaction costs into your portfolio, which may or may not really help you out. So I think 6 months we believe is very optimal. So there are multiple questions on 6 month rebalance. We've done quarterly, we've done analysis where we've done it quarterly, monthly. And what we've seen is that the differences in the long-term returns don't really matter as much. I mean, it doesn't really change. So it's pretty much the same. So we don't think that you're really missing out on anything by doing a quarterly rebalance. So what's the expense ratio of the fund? So the expense ratio of the fund is 1%. 1% is the expense ratio. That's what it is. Your direct plan will be about between 30 and 0.3 and 0.35. So that's the expense ratio. Rohan asks, what sectors will this fund focus on? Investment horizon, lock-in period. So there's no lock-in period. This is a mutual fund. So you can buy and sell whenever you want. There is a exit load for the first 15 days. So if you sell within the first 15 days, then there'll be a 1% exit load. But apart from that, there's no exit load. We would expect any investor who's coming into an equity fund to have a minimum horizon of 5 to 7 years. So 5 to 7 years is very important. You have to give any equity fund 5 to 7 years because that's just how equity investing works. You have to do it for the long run. So that's very important. And the sectors, it's a very good question. What sectors to focus on? And the answer is that no one knows. Whichever sector is working well is what the fund will focus on. If tomorrow healthcare does well, this fund will focus on healthcare. If tomorrow IT does well, this fund will have IT. If tomorrow banking do well, this sector will have banking. So it's a momentum style investing. So it will basically buy into whatever is working in the market, and that is what is very unique in the fund. So Manpreet asks, hi, being an NRI, can I invest in this fund? Manpreet, you can get back to, you can, if you want, if you can, please do, reach out to a relationship manager or someone at the AMC. Depending on your situation, we can figure it out if you're able to invest or not in this fund. So please do get in touch with us, through platforms. Jeet asks, what type of, being a mutual fund distributor, what type of investors should I suggest this fund to? So Jeet, this is a fund which is a very flexi cap, multi cap type of a fund. So any of your investors, any of your clients who have the risk profile of investing in a mixture of large, mid, and small, this could be a very good fund to suggest them to. So that's what I would recommend. It's also a high churn fund. It requires a little bit level of understanding. So please keep that in mind before recommending. So this is something which you keep in mind. There's no lock-in period for this fund. 15 days exit load, but otherwise no lock-in. It's a mutual fund. Just to let you guys know, there's also an ETF that we'll be launching in the next week or so. So investors can choose based on their preferences. However, index fund tends to be a lot simpler. So, this is a mutual fund that we're launching. What will the volatility probability and expected return? So the expected return and volatility probability is something which is hard to comment on because it really depends on the markets. This is a momentum style fund. So if say tomorrow only healthcare stocks or consumer stocks do well, then the volatility of this fund will go down because those stocks tend to be very less volatile. If tomorrow a lot of speculative industries like a lot of like PSUs and stuff do well, then the volatility will go up. So really hard to comment on overall volatility. But if you look at over 20, over 15 years, this index has a 10% higher volatility than the market. So just keep that in mind. So across market conditions, 10% more than market is more than Nifty is what you can recommend. In terms of expectation returns, I think you should expect maybe. I think it's be prudent to expect say 3 to 5% outperformance over a Nifty 50 over the long run. But obviously, it's very hard to give a number to you. And Arjun asked, "May I please know how this index will differ from other momentum indices?" Yes, we had a slide that compares the momentum 200 and the momentum 500 Nifty. So as you can see, this is a 500 stock universe. You choose 50 stocks. It is a combination of large, mid, small. Its returns are higher. Its risk is pretty much the same. We believe that this is a slightly better strategy because it's style agnostic, cap agnostic, and also sector agnostic. So, when small caps do well, it'll have a small cap exposure. Small caps don't do well, it'll go to large caps. So, it's a very dynamic index which will play stocks, sectors, and sizes in a very good way. We believe that the higher the universe, more the ideas, so the best momentum ideas will come in Nifty 500 as opposed to Nifty 200, which is why we believe that wealth creation will probably happen in this particular index the most. Also, this is a flexi cap strategy, so there are also momentum indices that track mid and small cap. The problem with momentum mid cap and momentum small cap is that you are essentially locked into mid and small caps. So if tomorrow small caps do badly, then momentum small cap will do badly, or mid caps do badly, momentum mid cap will do badly. Here, if small caps do badly, you'll automatically move the money with us. The exposure will move towards small caps to large caps or mid caps to large caps. So this is, I would say, a lot more safer, a lot more consistent, and a lot more bias-free index because you're taking the entire universe of investing. So we believe that this is slightly superior, at least from our perspective. So Jeet asked, so someone asked if Surya asked if momentum strategies are adopted, shouldn't rebalancing be more frequent? I don't disagree with you, Surya. Yes, I think quarterly is something which can be adopted, but we've done a lot of studies that so you have to give time to stocks to really perform. Momentum is not a quick thing; it's a relatively stable thing. And again, we have to understand that the stocks that are selected for this index are adjusted for volatility. So essentially, you're removing a lot of these speculative stocks that people keep talking about. So you're looking at stocks that are moving up, but moving up in a very stable way. And I think as investors, as fund managers, as asset managers, you have to give those stocks that are upward trending in a stable way some time to also perform. So we believe that 6 months is a good enough time period. We also feel that by adding a quarterly rebalance, you are increasing churn on the portfolio, as I said. So that'll only add costs. So we believe that 6 months is very ideal. For now, very hard to comment on the future. And we've also done studies, to be honest. We've done back tests where we've done quarterly, and we've seen that there's been very little value add of doing it quarterly. So that's what at least our studies say. So last question. This is by Jeet Rawat. Nippon India has also lost the same fund. Yeah, it's actually so I cannot comment on other AMCs, but yes, Nippon has launched the exact same fund. It'll be the same fund. Won't be any differences. So that's just what it is. But what's important is that this fund was actually designed by Motilal Oswal Asset Management. So we spent 6 months in 2022 making this index and then working with NSE. So again, the idea has come from Motilal Oswal Asset Management Company, and obviously it's an index, so anyone can launch it. But we did create the idea last year. So Surya asks, how will the upcoming US elections impact our stock market? Honestly, it's very hard to say. It has very less. So normally, we've done long-term studies on elections, and what we've seen is, and we've studied the last 12 to 14 elections in the US, which spans over 60 to 80 years, and what we've seen is that there's been no correlation between the US elections and the US market. Forget US markets and Indian markets. So what we've seen is that Yes, there might be some short term me over a couple of months, but there's been no long term trajectory change on the basis of any precedent coming in and going out. So I think that is the truth. The truth is that markets tend to follow earnings, and precedents do not really affect corporate earnings. They are very unless obviously they do something, they mess up with the economy and stuff. And we believe that the U.S. economy is in good shape and doing well. So we do believe that at least from a U.S. perspective, we don't see any big impact to Indian markets. I think even when Trump came into power, it was a pretty negative event, but we didn't really see much impact in global markets, and I think it'll be the same this time also. There's more questions. One question is from Ankit Kumar. This would be in a FlexCap category. So this is the index category. This is an index fund ETF, but the structure of the fund is going to be FlexiCap. It's going to be a combination of large, mid, and small, but the exact category will be an index. So it's a passively managed fund. It's an index fund. So that'll be its as per regulations. That's the category, but the portfolio will be closer to a FlexiCap type of portfolio, which will be a combination of large, mid, small. So I think I've gone through quite a few questions. Again, I thank everyone for coming on this call. I hope this was very useful, and I look forward to seeing good participation on the NFO. As I said, please do reach out to us. On our social media handles. We'll be happy to get back to you with any answers. And obviously, if I haven't answered anything, please also get in touch with me directly, and I'll definitely get back to you very soon. Thank you so much, and I look forward to having this in the future again. Thank you.